8 weeks ago, markets were pricing a comfortable surplus, traders were bearish. The consensus was unusually clear. Supply had the upper hand. Then the United States raided Iran, and the Strait of Hormuz closed. What happened next is the story this video is about. Everyone is watching Iran and the US. Its politics, its talks, its production. But supply shocks do not always reveal themselves at the source. They reveal themselves at the destination, in refinery run rates, in product markets, and eventually in consumer prices. The crisis is unfolding in India and Europe. Neither is ready. 8 weeks in, the market has spent most of that time pricing the geopolitical headline. That framing is not wrong, but it is incomplete. The more consequential story is what happens downstream, and it is already in motion. Every additional week of closure hits harder than the one before. This disruption doesn't add up. It multiplies. And as we go to press, the UAE has left OPEC. This is a tectonic shift for energy markets. 5 numbers define where we are right now. 560,000 barrels per day of India crude supply drop since February. A 77% drop in Middle East light product exports since March. $200 per barrel European jet fuel, 10 times Gulf floating crude storage since March 1st. And the UAE out. OPEC exit. The debate about when Hormuz reopens is the right question, asked of the wrong problem. The more consequential question is what comes back when it does. Reservoir production data circulating this week tells a stark story. More than half of Hormuz exposed production sits in low or very low pressure fields. Iraq and Kuwait, the 2 most directly hit producers, operate some of the most pressure depleted reservoirs in the region. Field intelligence is consistent on the timeline. Iraq's southern complex will not be fully back online before 2027. Kuwait faces a 4 to 5 month trajectory without accounting for subsurface damage, longer with it. And here is the historical precedent that should concern everyone. Iran produced at 6 million barrels per day in the late 1970s. After the post-revolution shut-ins, that capacity never returned. Not in 5 years, not in 20. Reservoir pressure loss is not a temporary condition. Once gone at scale, it does not come back. The fields behind Hormuz have been cold for more than 8 weeks. History suggests some of that capacity is gone for good. The market is pricing a door opening. It is not pricing what is behind it. The restart curve is a slow ramp, not a switch. Consensus is pricing the wrong variable. Now the destination story. And this is where it gets urgent. Government import statistics confirm what vessel tracking data has been showing for weeks. India's crude supply has fallen from around 5,300 kbd in February to around 4,800 in April. A drop of 560,000 barrels per day, absorbed almost entirely through lower refinery run rates. There has been no visible product shortage yet. That is about to change. India's summer demand ramp begins in approximately 2 weeks. Air conditioning load, transport demand, industrial activity, all increasing materially through May and June. Refiners who have been running light will need to increase throughput precisely as their feedstock supply is most constrained. The buffer has been used. There is no second buffer. India is not only a major crude importer with roughly 60% Hormuz dependence, it is simultaneously a major regional exporter of jet fuel at approximately 161,000 barrels per day net. When Indian refiners cut runs, that product disappears from global markets. Australia, Hong Kong, and several Southeast Asian economies depend on it. The choice facing India in the next 2 to 3 weeks: source Atlantic crude at a significant premium, draw down stocks, or cut export commitments and export the shortage to its neighbors. Each path has a different price signal embedded in it. None of them is without consequence. Europe is the story nobody is watching closely enough. Major European economies are significant net importers of jet fuel. The UK alone imports approximately 186,000 barrels per day. Primary suppliers, including Kuwait, South Korea, and China, are all either directly Hormuz exposed or dependent on Hormuz exposed feedstock. Here is the data that confirms the damage is already running. Middle East naphtha exports fell by more than 75% between February and March, from around 1,400 kbd in February to around 330 kbd in March. That collapse has not yet fully transmitted into European consumer prices. Product market tightness takes 4 to 6 weeks to reach the retail level. The clock started in mid-March. The summer aviation season opens in 6 weeks. European carriers are currently either hedged or compressing margins. By June, that protection runs out. Jet fuel at these levels becomes a headline the moment airlines announce route surcharges or cancellations. And that is the moment this crisis stops being an energy industry story and becomes a political story. Governments will face pressure to act. Most have limited tools available. A closed strait does not just strand crude, it removes the product stream that keeps European aviation running through summer. That transmission is already in motion. The market has not yet priced it. Here is one of the most striking data points of this entire crisis. Satellite vessel positioning data shows floating crude storage in the Gulf rising more than tenfold since early March, from approximately 8,000 kilobarrels on March the 1st to over 81,000 as of last week. Laden tankers are being used as floating storage because onshore facilities at key export terminals are at or near capacity. The crude exists. It cannot move. And when Hormuz reopens, this overhang does not clear overnight. Several compounding delays stack on top of any political agreement. The first 1 or 2 weeks will focus on mine clearance and transit safety verification. Watch for vessel crossings above 30 laden crude vessels per day as the first confirmation signal. Then comes tanker fleet repositioning. The available fleet has moved to the Atlantic. Repositioning adds 2 to 3 weeks before a single barrel reaches an Asian refinery. After that comes the field restart ramp, which could take 8 more weeks. Low pressure fields require workover and careful restart sequencing. Iraq and Kuwait will not return to pre-crisis rates quickly, regardless of what happens above ground. Iran is even more exposed. Very low pressure fields account for roughly half of its production. The initial reopening could look like a glut in the futures market, even as physical tightness persists in product markets. Those two signals will diverge sharply and briefly. Traders who understand the difference between the paper signal and the physical reality will have the clearest edge in that window. And then, the United Arab Emirates announced its departure from OPEC, effective May 1st. Officials from other member countries describe being blindsided. It is the most significant structural shift in the group since the formation of OPEC Plus in 2016, and it lands at a terrible time. The timing is not accidental, with UAE production throttled by the Hormuz closure. Seaborne trade flow data shows UAE crude exports fell from around 400,000 barrels per day in February to around 2,300 in April, a drop of nearly 1,200 kbd. The political cost of leaving is lower than at any point in recent memory. OPEC quotas carry little signal when you cannot ship the oil. And when the strait reopens, the UAE wants to be free of them. The UAE was OPEC's third largest producer. It was already producing above its official quota. Its stated intention upon reopening: increase output unconstrained. Production capacity is estimated at 4 to 4.5 million barrels per day. The gap between current constrained flows and that ceiling is where the post-crisis market story will be written. Here are the structural numbers behind the UAE departure. UAE crude production in 2025 averaged approximately 3.1 million barrels per day, well below installed capacity. That gap is attributable almost entirely to quota constraints. Abu Dhabi National Oil Company is targeting 5 million barrels per day of capacity by 2027, with stated ambitions towards 6 million thereafter. The departure removes the ceiling on monetizing that investment. The potential additional supply, roughly 1 to 1.5 million barrels per day above current constrained levels, is now unmanaged, and this compounds further. More than 65% of OPEC plus effective spare capacity sits with Saudi Arabia and the UAE. With the UAE outside the group, approximately 1.5 million barrels per day of spare capacity is no longer subject to coordinated deployment. The near-term read is not straightforwardly bearish. The market needs every barrel it can get. The UAE's departure does not add a single barrel while Hormuz is closed, but when the strait reopens, the UAE will pump without ceiling. The UAE exit has two scenarios that define the price range. Scenario A is an orderly exit in which the UAE pumps freely post-reopening, and Saudi Arabia absorbs the adjustment, leading to a well-supplied market in the second half of 2026. The ceiling for Brent held below $100. This is the base case. Scenario B, Saudi retaliation. Riyadh opens the taps in response, as it did in March 2020. A short-term supply surge crushes post-crisis prices. This is the tail risk not currently in consensus pricing. The probability weighting matters. The market is currently pricing the Hormuz reopening as a bullish event. The UAE exit introduces a scenario in which reopening triggers a supply surge rather than a controlled recovery. The short-term and medium-term signals point in opposite directions, and beneath both scenarios sits a structural shift. Historically, OPEC plus spare capacity acted as a shock absorber. With the UAE outside the group, that buffer is smaller and less coordinated. The result is not a clear directional bias in price, but wider and less managed price cycles. Volatility becomes a permanent feature rather than a transitional one. That is a regime change for anyone pricing oil risk. On price, major agency forecasts put the floor for crude at $80 to $90 per barrel, even in a full reopening scenario. That floor is credible, but the floor is not the interesting question. The ceiling is. And it depends almost entirely on the India and Europe transmission described before. If Indian refinery run rates spike in the next 2 to 3 weeks and product shortages materialize visibly, the price signal will not be gradual, it will be abrupt. Market pricing puts a 30% probability on Hormuz reopening by end of May, 60% by end of June. There is one further dynamic not yet in consensus pricing: post-crisis restocking. Governments and refiners who were caught short will not allow that to happen again. This restocking will add demand pressure for 6 to 12 months after supply normalizes. The price premium does not end when the strait opens. It transitions from a supply premium to a restocking premium. One final point. The market is struggling with price discovery right now. One significant geopolitical headline can remove $15 from Brent in a week. Futures and physical markets are running disconnected. Capital is not flowing where the fundamentals point. This is not a stable condition. It resolves, usually abruptly, and usually in the direction the physical data has been pointing all along. 3 signals to watch before the next issue. First, ceasefire negotiations. Back-channel talks are reportedly underway. Any credible signal would be the single biggest price catalyst in either direction. A genuine agreement could unwind $15 to $20 per barrel overnight. Watch for a sustained uptick in Hormuz vessel crossings above 40 per day as the first physical confirmation that any agreement is translating into action on the water. Second, India refinery run rates, the 2-week clock. Any data? Government statistics, satellite-derived refinery activity, product export figures, showing Indian refiners increasing runs despite the supply constraint signals the product crunch is imminent. This is the leading indicator of the next phase of the crisis. Third, European jet fuel spot price, currently at $200 per barrel. A move above 220 triggers airline surcharges, political noise, and consumer price headlines. That is the moment the oil market story becomes a mainstream economic story and the political pressure to act on both sides becomes acute. The market moves when India runs short and European flights get cancelled. That's not a geopolitical story anymore. That's a consumer story, and it's 2 weeks away. That is issue 2, the wrong country. Subscribe to our free weekly newsletter at crudeoildesk.com for more in-depth analysis, including full data tables, country-by-country breakdowns, and the Iran production chart going back to 1954. If you found this useful, subscribe to our channel so you don't miss the next video. We publish every week. I will see you there.